One decision, one signature, and over $1 billion vanished. This company was supposed to change how the world works. Instead, it became one of the most expensive lessons in modern business. Stay with me, because the moment everything broke was invisible at first. At its peak, this company was everywhere. Glass buildings, minimalist logos, words like community, future, innovation. Investors called it the next tech giant. Employees believed they were changing history, and the founder believed the rules didn't apply to him. But behind the hype, something was rotting, quietly, patiently, and when the truth surfaced, billions were already gone. It started as a simple idea, office space reimagined. Instead of boring cubicles and long leases, this company offered flexibility, shared spaces, creative energy, a lifestyle, not just an office. Startups loved it. Freelancers flooded in. Cities welcomed it. Money followed fast. Venture capital firms didn't just invest. They rushed. Valuations exploded. From millions to billions. The company wasn't profitable, but it didn't matter because the story was powerful and the founder sold it perfectly. He wasn't pitching offices, he was pitching a movement, and investors bought the dream. But early on, there were cracks. The business model was fragile, long-term leases, short-term customers. That mismatch? Dangerous. Internally, spending was wild. Private jets, lavish parties, questionable personal transactions. Leadership blurred lines between company money and personal money. Red flags were raised, then ignored. Why? Because growth was intoxicating, and nobody wanted to be the person who said, slow down. The numbers looked big, but the fundamentals were weak. Still, the hype machine kept running. Then came the moment, the decision that changed everything. The company decided to go public, an IPO. For most businesses, this is a celebration. For this one, it was an autopsy. Once financial documents were exposed, the illusion collapsed. Losses, conflicts of interest, governance chaos. Investors didn't see a tech company anymore. They saw a real estate business. Burning cash, confidence evaporated overnight. Valuation dropped, then dropped again, then collapsed. From nearly $47 billion to a fraction of that in weeks. Funding dried up, layoffs began. Thousands lost their jobs, offices closed, expansion plans were scrapped. The founder was pushed out, reputation destroyed, and the biggest backers, they absorbed losses in the billions. What was once a symbol of modern work became a case study in excess, ego and denial. The company survived, but the dream didn't. And the cost? Over $1 billion erased. Actually, much more. Here's the real lesson. Hype can hide reality, but only for so long. Growth without discipline is a trap. Charisma without structure is dangerous, and vision without accountability is fatal. No matter how beautiful the story sounds, business fundamentals always win, always. So here's the question. How many companies today are being valued on dreams instead of truth? And when the curtain finally lifts, who pays the price? If stories like this make you see business differently, consider subscribing, because the next collapse is already being built.